These talks are brought to you by Claritax Books and are proudly sponsored by Six Forward Capital Allowances.
Welcome to the next in our series of talks about capital allowances. This week I'm going to start on the topic of fixtures in property. This is an area where the amounts of money involved can be huge and where many difficulties can arise. To understand how the rules work, I think it's helpful to begin by asking why we need special rules for property fixtures at all. And this takes us back to Section 11, which we looked at early on in this series. Section 11 tells us that expenditure can only qualify for plant and machinery allowances if the person incurring the expenditure owns the plant or machinery as a result of incurring it. For fixtures in property, that ownership condition creates a major problem. Suppose, for example, that a tenant of a large office spends £50,000 on installing an air conditioning system. The tenant incurs the expenditure, but in property law terms, the new system belongs to the person with the freehold interest in the building. The point came to a head in the case of Costain Property Investments, which confirmed that landlords' fixtures could not be said to belong to a leaseholder. So in that case, the landlord could not obtain allowances on the expenditure as he had not incurred the cost, and the tenant could not claim allowances as he did not own the assets in question. Although it felt compelled to reach that decision, the court could see no reason of principle to justify the outcome, and commented that the ambit of the legislation ought to be reconsidered. The legislation was indeed reconsidered, and new provisions relating to fixtures were introduced from 1985. Those provisions, as since amended, now make up Chapter 14 of Part 2 of the Capital Allowances Act. That chapter begins with Section 172, which states that the chapter determines entitlement to allowances for plant or machinery that is or becomes a fixture. The exact way the fixtures rules get round the ownership problem varies, but the general principle is to create a pretense of ownership so that the person incurring the expenditure is deemed, for capital allowances purposes, to be the owner of the fixture. To apply the rules, we must understand the statutory definition of fixture as it applies for capital allowances purposes. A fixture then means plant or machinery that is so installed or otherwise fixed in or to a building or other description of land as to become in law part of that building or other land. The key point, and this is really fundamental to getting the tax treatment right, is that this tax definition is different from the terminology that may be used in the business accounts. Take, for example, a newly constructed GP surgery. And let's focus on, say, the central heating system and on freestanding tables and chairs in the various consulting rooms. The accounts will show the central heating system under some such heading as additions to property, while the tables and chairs may well be shown as fixtures and fittings. So it's easy to suppose that the fixtures rules would apply only to the tables and chairs. But this is exactly the opposite of the reality. The central heating system, though correctly classified in the accounts as part of the property, is for capital allowances purposes a fixture. The tables and chairs are certainly plant and machinery, but they are not fixtures in the tax sense. Next week, we'll start to look at how tax relief is given in practice for fixtures in property. Thank you for watching, and I hope to see you again next week. I'm Ray Chidell. This talk was brought to you by Claritax Books and sponsored by Six Forward, an independent property tax consultancy working with accountants to enhance capital allowances for their clients.